it's like you always want to keep things in perspective. So you think about how much something affects something. But imagine if Apple went up 5%, that would take the entire NASDAQ up 1%. And that's where we are. So, so it's not that impressive that the NASDAQ is up 0.23% with Oracle up $250 billion. So we take it as it comes. I still never fix that thing, but anyway, so you can see what's going on today. And let's take a look at the bigger picture with the futures. La-da-da. So we've been adding all the tech laggards lately. We added Qualcomm, we added Oracle. Well, Oracle's not a laggard really. We added Qualcomm, we added Oracle. We just added Cisco. They're more nuts and bolts plays for the internet. So in other words, Oracle is almost like buying a pipeline when natural gas prices are going up. It's like you don't know which natural gas company will be the winner, but you do know a lot of natural gas is going to get pumped around the pipelines. That's what Cisco is. Cisco is pipeline and storage for data. But they are also moving into adding their own AI. And well, we'll get into that when we talk about the chat. Let's see where we are. Should do one thing at a time, but it's hard to. La da da. Oh, look, a top trade on Cisco. And a top trade on Oracle. What a day, what a day. What's this say? Subscribe to our notifications for the latest news and updates. You can disable at any time. It's a very passive sort of thing, don't you think, Maddie? We need something more aggressive than that, like subscribe or you will miss out on billions of dollars of profit, something like that. I don't know. I think something more attention grabbing. Anywho, what are we doing? Oh, okay. Let's start with this. We need a new Bodhi. How old is this Bodhi? I think we made a new one last week, right? Page up, page up, page up. Oh, there we go. Yes, no. Page up. Oh, that's a lot. Whoa. Oh no, he's got a shit ton of stuff. All right, let's make a brand new Bodhi. Huh? No, that wasn't Bodhi. Ew. Spaces. Bodhi collection. Yes, I need a new Bodhi. Okay. If you want the job done right, you don't ask the regular version, believe me. All right, so here we are. What model are we using, please? Set sources for search, set recency, attach file. What's that? Voice mode. All good. I don't know what that is. Okay. Please give us a comprehensive summary of what quarter was this? Q2 earnings, right? Q2 earnings reports. It was July 1st that they started, right? Through please give us a comprehensive Q2 earnings reports July 1st to 2019 by sector with any outstanding notes and trends you are picking up on. very interested in how tariffs, inflation are affecting things. And of course, out looks for Q3. This is going to take him a while. What you see now, this is just his plan for what he's going to do. This isn't even, this has nothing to do with what he's doing. This is just him planning out how he's going to do his research. And then he's going to start doing research and blah, blah, blah. And meanwhile, it's only going to take 5 minutes, but still, it's a lot longer than usual. Anyway, so where were we? Oh, today's post. Yes, let's take a look at today. All right. So yeah, as of this morning, it was 225 billion. It's well over 250 billion now that they popped overnight. And what led to the this gigantic move in Oracle is what they call remaining performance obligations, and that's essentially it's just their backlog of orders. So when it says performance obligation, it means that there's a signed contract for what? For $455 billion worth of additional business that Oracle has not performed yet. Now, in a service company, they always have performance obligations, and usually with Oracle, it's going to be a couple of years worth of revenue, so something under $100 billion of forward performance obligations, probably $80 billion, something like that. But what you have here, and what I said here, is it's a 359% increase over last year. So in fact, if last year was 100 billion, then now it would be $350 billion more, which is 450 billion. So basically, there's the math, right? So in the normal course of their business, you know, Oracle has an obligation to say, we have contracts for $100 billion worth of business over the next 5 years, and obviously some new business comes in and new business goes out and whatever, and that's just how you track the normal business. So what they're up to now, the growth has been 3.5 times from last year, and that's only so far because there's contracts in negotiations and things that are being pushed forward. And as I noted now, these were their contracts before this year, before all this stuff got promised to Trump, before Trump was in office. Because remember, since Trump's been in office, Meta has promised to spend 600 billion, and Apple's promised to spend 500 billion, and Amazon is spending 400 billion, and whatever. I mean, and Nvidia is spending 500 billion, 600 billion, whatever. So on the whole, there's been promises. And by the way, when you hear these promises, this is not money they weren't going to spend anyway. They were all racing to build AI. They're just giving Trump credit for it. You know, it's like Boeing. Well, they did it. I was going to say it's like if Boeing promised they were going to build planes. Yeah, Boeing did the same freaking thing with Trump. They promised that they would build a couple of $100 billion worth of planes. Meanwhile, of course, that's their job. That's what they were going to do. It had nothing to do with Trump. They were going to build the planes because they have orders for the planes, and therefore they're going to do their job and run their company like they're supposed to. You know, it's like AT&T saying next year we will do 400 billion phone calls. We will do 400 billion phone calls next year. It's like, yeah, that's what you do. That's your job. It didn't have anything to do with Trump. And then Trump gets on TV and says, over the next 10 years, AT&T has told us they're going to do 4 trillion phone calls, and I've taken credit for it. So if you speak on the phone, then say, thank you, Mr. Trump, when you pick up the phone. That's the kind of freaking world we live in now. It's just so crazy. And by the way, if you want to see Trump's ass kissed, look at it, watch a cabinet meeting. Oh my God, is that sad? There's no meeting. There's no actual meeting. They don't talk about anything. They just go around the table kissing Trump's ass. And then it goes all the way around the table and it gets to the last guy. And then the next guy goes, oh, yes, by the way, mwah, 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 mwah. And they start kissing his ass all over again for another set of things. Because the first guy's like, oh my God, I didn't mention that. I got to mention the thing that the guy over there mentioned. That's how it works, because as they go around the table, some of the guys come up with new things to kiss his ass about, and then the people who didn't kiss his ass about that start worrying that they're going to get executed for not kissing his ass on some other topic, so they start kissing his ass some more. It's freaking amazing. And this is our country. It's not like a freaking Borat movie. It looks like a Borat movie, but it's not. But anyway. So, yes, that was important. I'm sorry it was a sidetrack, and I'm sorry it's about Trump, but that was important because you have to understand where this all comes from. So, you know, Oracle was always going to do another $100 billion worth of business, but now it's $450 billion worth of business. But meanwhile, maybe they were always going to do that too. But in order for Microsoft to fulfill their promise to spend $400 billion, they take $20 billion that they were going to spend on Oracle anyway over the next 2 years, and they double it and make it a 10-year contract. So now it's $40 billion a year. For 10 years is $400 billion. And they say, look, Mr. Trump, we're doing $400 billion. And all it really is just a normal expansion of their AI growth with much longer contracts. Okay? Just so let's not get all crazy excited about these numbers, but it still shows you some tremendous growth in AI. There's still a realistic play here because we're treating Oracle, or we have been treating Oracle, like a normal company. We're treating them, we've not been treating them like NVIDIA, but they should be treated like NVIDIA because Oracle is already in this business, just like NVIDIA was already in the chip business. They were going to sell chips anyway. They're just selling more expensive chips. Oracle is now selling more expensive data centers. Much bigger, much more expensive. Wow, this does not reprint. This does not recalculate itself. That's pretty sad. That's yesterday's number. So they're just under $1 trillion right now, Oracle. But anyway, these numbers don't change. So here's Oracle's business. Up 5%. Up 15%. And this is up 3, which is up not even 10%. And this is up 5, which is up 10%. Right? So normal. But now they're going from 57 to 66. That's 9. That's 15, 18%, right? And they go from 66 to 79. That's 20%. That's before the announcement. Now with the announcement, those are doubled. So you're talking about, you know, 30, 40% annual growth consistently for years to come. And that means that when you look at 33 times earnings, they're wildly undervalued. You know, 33 times is aggressive unless you're growing 30, 40% a year, in which case it can't possibly cover it. Why? Because if your earnings now are 100, look, to be 33 times earnings, if you were making $100 million, then you would be at 3.3 billion. That would be 33 times, right? So if you had 100 million in earnings, 33x would be 3.3 billion. But if your earnings are growing at 30% a year, then in 3 years you'll be at 200, and that's going to be 15x, 16x. So you're going to drop, if your earnings keep growing at this price, and you're dropping quickly, very, very rapidly from 33x down to 15x. And if you're still growing at a 30 to 40% rate, then 15x is going to be stupidly cheap, right? So the question is, do you buy it now or do you wait? Well, if you wait, it's probably going to be 2 to 3 times higher in 3 years. It's not going to, the stock's not going to wait for you. Other investors are going to see this train coming and jump on. So, you know, if you want to get involved, and look, we missed NVIDIA, we did not play it, but I don't see any reason not to play Oracle, because Oracle has a big, huge play. but also they have a big plus. And the big plus for Oracle, which we did not even talk about, we had this whole article talking about Oracle and how amazing they are. Cloud services, $6.2 billion. And this is, by the way, 2 quarters ago, because I don't have one of these updated. These App Economy guys, you know, they do it when they feel like it, not all the time. So their cloud services were 6.2 billion. License support, it's a big thing, is 4.8 billion, right? But it's going to get left in the dust because that's not going to change very much. Hardware, nothing. Services, not much, right? It's really all about cloud services and licensing, right? And that's most of their revenue. So you have to look at where, you know, it's always, you got to know where the money comes from. And here you can see like tremendous amounts of money from cloud services and licensing, and much less from anything else. And we had this whole big, huge article in the morning, and we didn't even talk about the most important thing. I mean, look, it's still going. There's a huge morning article about all the, you know, about almost all this is all about the things Oracle is actually doing right now. But what they're about to announce in October, which is next month, it's not even far away. I wasn't thinking about that this morning. I wasn't thinking like October was only like next month. But oh, son of a bitch, every time. All right. Gotta sign it. See, and if you're not a member, this is exactly what you miss out on. So then we had a discussion about RPOs and how they work and what the good and bad sets about them could be. And that's what reminded me. I said we're not even counting Oracle's upcoming initiative for corporate America, and then I had Bodhi explain it all, and that's their data plus LLM. Now, basically, what that means is, first of all, I want to say more than 60% of businesses have their data on Oracle. That's their secure cloud platform that people use, and that's because Oracle was partnered with Microsoft in the 1990s to do this sort of thing, and it's been ever since. You know, Oracle SQL databases and things like that. So huge amounts of corporate data is already on Oracle's platform. And what Oracle's doing is now saying, instead of the mess that we have now, where you have to build a ChatGPT project or an LLM project locally and then bring your data in or pipe it through the cloud or blah, blah, blah. They're saying, no, we're going to let you take the data that you already have on our storage, or you can move your data to our storage, obviously, is another thing. And we will then integrate it into an AI database for you, but you will maintain all of the security on your data so it doesn't go out and you don't have to worry about it being stolen on the cloud or anything like that. That's huge. Like, I know somebody who worked for an insurance company, and the insurance company was using because they had to run ChatGPT on their own system internally, because that was what was advised by their IT people and the security and all that. Then all that data, and of course you're responsible for your data when you're a corporation. Then all that data though was running. The computer systems they had in house couldn't possibly handle it. And I'm talking about a national company, not a little company. And all their stuff could not handle it, and therefore they ran their solution was to run a 2.1 version of ChatGPT, because they couldn't handle a larger version on their computer. So it was running this horrible, slow, mistake-prone, awful version of ChatGPT from 2 years ago because it took up less space. That's happening all over. And that's why, again, when you look at these numbers and say, oh, 95% of these AI projects are failing, they're failing for stupidity like that. Like nobody's doing it properly. So Oracle is solving a huge problem for a huge number of businesses by saying, no, 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 you can take the system you have now and securely keep it secure, and we'll build the LLM on top of it, so you will then be able to access it, and we will update the LLM and keep it current and help with technical support and blah, blah, blah. That's like music to a company's ears. They're like, holy crap, because you can go to your board and say, oh, Oracle's gonna handle it, and they're gonna go, oh, thank God. They're not gonna be upset. They're not gonna call the IT department and say, what do you think about Oracle? It's Oracle. So that's huge. And as Bodhi said, he goes, think of it as AI in the box. And they're going to use their expertise. This is where it gets sensitive though, because if they figure out something for, like, let's say they figure out something for Merrill Lynch, right, for a solution, are they then able to give it to their other financial customers for free? No, it's, you know, the question is who owns this stuff. Now I guarantee you Oracle is going to own most of the stuff that they do for the consulting part of it, and it'll be a benefit to everybody over time, but it'll piss off the people who pay for the first solution. But tough luck, that's just the way it works. I think the thing you should learn is don't pay for a first solution, just wait till somebody else does it and then take theirs. So don't send data to the AI, bring the AI to your data, blah, blah, blah. Business model geniuses, they're renting their services. That means they're always going to charge you for it. It's coming up soon. It's a huge catalyst. It's on the way that people are not. This thing is taking into account contracts that already exist. Now there's going to be a new wave of contracts going forward. And also in such a way that they're going to be adding revenues to things that they're already doing with customers they already have. So it's wonderful. So traditionally the Oracle customers, and forget everything else, 1 to 3 million per customer. The AI enhanced Oracle customers, 3 to 20 million. So you're talking about at least 3 times more from the same customers in revenue, could be 10 times more. So this is not a small thing. This is a massive, massive additional thing that you want to look at. So it makes me very, very comfortable with the numbers that we're looking at for Oracle and so on and so forth. And therefore, because of that, we did a top trade. And now we'll find that. And also you want to take advantage. I mean, you got a pop like this in Oracle. Ooh, 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 everybody's turning down. What happened? Minus, is everybody minus? Ooh, not the S&P so far, not the NASDAQ. Okay, still not pretty. No, I don't want the latest Windows updates. What were we gonna look at? Oh, Oracle. Got me all confused. Okay, so we want to take advantage of this crazy, at the moment it's 39, almost 40% up today. So I got to look at that and say, well, how can I sell premium? And so we look at the 350 calls in November, and they're 22, 23 bucks. I want to sell those. That's kind of crazy. It's at 330 and it just went up 40%. So will it go up 50% without a pullback? Probably not, but even if it does, we're figuring out a way to cover it. So you have to have that seller's brain. You have to think, how can I take advantage of what's happening? So I said we discussed Oracle extensively yesterday in this article, blah, blah. Here's Oracle's what it's going, 41% up on that chart. Understanding the premise is what I just told you about. And what's the play? First of all, I said, now understand that we're at 350 now, or 340. 340. So we're at 340 now, and I said, well, what do I want to do then? Let's sell the 250 puts. Why the 250 puts? Because I wish I had caught Oracle at 250. It's gotten away, and it's probably never coming back. But you know what? I can still say that I'm willing to buy 500 shares of Oracle for 250 bucks. And you know what? As crazy as that is, it's like, would I want to do that? Of course I would. Why would I not want to buy 500 shares for 250, knowing now what I know? Knowing about this new information, obviously 250 was way too low. Therefore, I can still, before the puts get drastically repriced, I'm promising to buy 500 shares. So I'm selling these puts for 20 bucks. That's going to net me in for 250 minus 20 is 230. 230. 230 is way down here. I'm pretty comfortable with 230. We were at 200 back in the beginning of the year. So I'm promising to buy Oracle for net 230, and we're collecting $10,000 for promising to do it. So in the short-term portfolio, what does that mean? That means unless the market goes seriously down, we're going to get $10,000 free dollars. A flat or up market is almost certainly going to make those puts expire worthless, and we pick up 10,000 bucks, and that pays for our next set of hedges, or helps pay anyway. Now, in the long-term portfolio, it's a more serious trade. If the STP gets in trouble, I'm going to end up eating these puts, and we're going to roll these puts, but we're going to roll them to the long-term portfolio. So that's why we only sold 5 here, because I already sold 5 here in this portfolio. I'm not going to sell 10 here, then we have a bit too much in case something does happen. But it's the same thing though. We're selling 5 puts here for $10,000 free dollars. There's almost no chance in hell that we're going to have to pay that back. And that means also, by the way, so when we have an allocation block, and part of the allocation block is we have an obligation here, but we don't consider this a real obligation. Like the chance of this happening is incredibly remote. So we'll discount the allocation block and not consider it heavily used. You have to evaluate your allocations to say, is that a realistic allocation or not? And sometimes you should be allocating more, and sometimes you should be allocating less. Usually I'm going to pick a play where the goal is to allocate less, not more. Otherwise, why would I be picking it? We're buying 20 longs, 300s, which are in the money by 40 bucks. So this is 50% in the money. So 20 times 40 is $80,000. So this trade is $80,000 in the money. We're selling 15 short calls, but a year earlier. So this is December 27, that's January 27. And that means we're going to have a chance to roll those. Oh, that's why I wanted to go to Thinkorswim. That's right. It's very important. So, what was it? The 300s and the 380s, right? Okay. So, June. So here's the January 300s. They are currently 83 bucks. Oh, is that right? No, sorry. They're currently 89 bucks. So here's 89 bucks for the 300s. Whoa. Messed that up. And, oh, I did that wrong. These are the 300s that we're buying. They are 106, 107, somewhere in that range, sorry. And then the I keep hitting the wrong bar. It's this bar. And then the 380s, there you go. Now my brain is correct. The 380s, which are way at the top of the chart, the 380s of 2027 are 54 bucks. All right, so the spread right now, oh my God, every time. I am not learning at all. It's funny because my AI does that. I yell at it because I'm like, how could you not learn? It's like, well, I'll learn more pity next time. So These are 104, 105, 106. Let's stick with 106. And oh my God. Wow, because this is on my main computer. This would never happen. That's not how it's set up, and I just keep screwing it up. I think it was 106, and these are 55. So let's call it a $50 spread. So it's an $80 spread in strikes. It's $50 in cost, but we have a whole other year. So if what you really want to look at is what costs $55 in. Wow. I gotta hire someone to do this for me. It'll be like cheaper than me doing it myself and going back constantly. Oh, you can't even tell. But look at the 380s. So for example, the 380s of 2027 are 75 bucks. And what's going to happen is if Oracle stays where it is, 400s will come out, 450s will come out, 500s will come out, the 2028s will come out. So we're going to get 2 chances to sell that premium, and we're going to be able to roll it to a higher strike. I seem to be only capable of hitting that one. And the other cool thing, which I already said, is the November 350s that we are able to sell now because we have this big spread protecting us at 22 bucks. That's a massive amount of money. We get 10 chances to collect that money. This is huge money. So we're going to collect $20,000 10 times, a couple of $100,000. And that's why we jumped on this trade. It was because the premiums are so jacked up that we got a great chance to sell it. So we bought the 300s that are a bit in the money and have much less premium. We sold the 380s, and we also sold the 350s as short calls against. And like I said, we sold those puts that we absolutely would not mind being assigned. I touched the right place. Oh, I'm so excited. All right. So that's the trade that we just sent out as a top trade alert. In this case, it was net $98,000. It changes like constantly, these numbers, so you got to be careful. But we wanted to take advantage of this because it's already down to 20, and it was 28. Because that was just a crazy bump, and that's the thing. You have to say to yourself, that's a crazy bump. It doesn't make sense for it to go any higher, and therefore I want to sell this premium right now. That's why we jumped on it, because we have this chance to sell this incredible amount of premium. And when it settles down, we'll sell puts and we'll sell calls and whatever. But for now, while it's going up, we're only selling the short calls. So that's our anchor spread, is this $80,000, I'm sorry, $160,000 anchor spread, right? And we're spending $98,000. So there's $60,000 of upside covering these short calls. So Oracle would have to go over $400 before this hurts us really. All right, and we don't think that's happening. We don't think that's a realistic number based on what they've got so far. So we'll see. And by the way, and if it does, I'm happy to buy more bull call spreads, right? That are 113 minus 60, which is not even 60 bucks, right? Well, we said that already. It's 50 something dollars. So I don't mind spending $50 on $80 spreads, especially when they have more rolling time to them, because there'll be $100 spreads or more than $100 spreads when I'm done with them. So that is exciting. We did a summary here. Putting it all together. We did very, very extensive conversations about it in the member chat room. And then we also did a top trade alert on Cisco as well, because again, I was looking, I'm thinking like, what else is infrastructure? And we picked a few in the Morning Post. Well, we picked a lot. We had a lot of trade ideas for what'll work in this market. So the thing is, Google and Amazon, of course, are also in the business that Oracle's in, but for them, it's not a big piece of their business, number one. Number two, competitors don't necessarily want to give their all of their data to Google and Amazon. That's always going to be a problem for those guys, although Amazon's done a great job with their web services, but it's not a focus. So if I invest in Amazon that has, that has $1 trillion in sales and 100 billion of it is Amazon Web Services, it might be more. It turns out it's almost all of their profits come from Amazon Web Services, but still it's a huge company and it's not their primary focus and so on and so forth. A lot of people argue they should be spinning it off actually. And Google, of course, has all their projects. So Oracle really is the leader, and since that's a whole company's purpose, you get the best leverage on any upside effect from them. Then there's CoreWeave, which is building a GPU specialized infrastructure. They're a fairly new company. They zoomed up on their IPO, came back down a bit, and now they're kind of steadying out. This is probably not a terrible price for them. Nebius Group also, they've been around for a while, but also they're just sort of just catching on, but they had that tremendous sell-off. It just shows you how hard they can get hit. I mean, they basically look like they were going to go out of business, and now they're coming back. It's a little crazy, but you got to look at all the different possible ways to play. Then there's Broadcom, of course. We know they took off already. NVIDIA, of course, is already taking off. And we talked about the timeline. How fast will this play out? Well, Oracle is focusing on execution on backlog right now. They've got capacity constraints, and of course, competitors are going to be coming in also. So that's what you got to watch for. And we talked about some of the different companies that we can play. And I was looking at those, and I said, you know what? At the moment, I'm most comfortable going with Oracle for a long-term play, but a long-term income-producing play, and going with Cisco. And again, because I just feel like they're the pipeline plays for this stuff, and I don't have to worry about one company beating another company and so on and so forth. So then we talked about that. Then we talked about what can go wrong with the RPOs. And honestly, it's just, if you want to say what could go wrong, that's what could go wrong. But honestly, it's not that likely. The data LLM project is huge, so we talked about that, which led us to those two plays that we just had. Here's a Lockheed Martin play we looked at. Warren did a good little explanation of the mechanics for that. What is this? Oh, we left Bodie hanging, poor guy. Okay, so here's our morning report. PPI came in low, so we'll see if CPI backs that up tomorrow, but it's good. It's good, but you can't trust the data because who knows what the BLS is doing now with this crazy revisions and everything they're doing. Oh, and then Warren had this really good explanation of this trade, of the Oracle trade. He had a wonderful breakdown of that to explain exactly how it works and how it's going to make money and so on and so forth. That's nice too. Here's Cisco. Then we did our normal thing that we do every day. And what do we do every day? We have this is G-Money. It's a Gemini project, and because Google's Gemini has the largest capacity for data right now. Now, Oracle is going to blow that away. So what Oracle's doing is going to be much, much better than what Gemini is doing. That's very interesting, but it does depend on what kind of price point they come out at. But for a company like ours, where we can make pretty good use of that stuff, we'll have to see if it's worth it. But if we could take all of PhilStockWorld stuff and all the trades we make and all the trading logic that we've had over the years and put that all into one model and then train the model on what, like it'll come back, and what will happen is I'll sit down with it, and every day I'll be like, I'll say to it, which is what I do now with Bodie and stuff and Warren. I say, well, go ahead. I said, here's the trade. You figure it out. And then they give me their answer, and I say, okay, that's right. That's right. This is wrong because, and I explain to them, this is why this is wrong. This is why this is right. This is something you should have looked at. And that's how they learn. I train them to be better. But if I could train them to be better on all 20 years of PhilStockWorld publications and everything we've done, and it'd be fantastic, believe me. And plus, if they could access all the live data off the markets right now, that would be amazing. So, and they will. I mean, I've always known this was going to happen. I just didn't know Oracle was going to come out and put a product out in a month. It was going to happen eventually. Bureau of Label Statistics. So what we do is we have G Money comes in, puts together all the news with links highlighted, so you can go and check the actual articles. I used to do I have to put up links myself, and now this is much better because I think it's just got a little, he's doing a little summary explanation of all the news items that are worth paying attention to. And I, of course, edit this before it comes out. And so I add things and subtract things and whatever. But it's a great time saver for me because I used to spend my whole day reading the news basically, and always just reading articles so I could figure out what would go in. And I would read, I always used to complain to the members, I'm like, I read 10 times more stuff than I actually show you. And that's what drives me nuts. It's not the actual articles here, it's the ones that I read that were not worth reading. Not only that though, but I read like 3 times the same article because I want to give the best one. I don't know which one's the best one to read. I have to read the same article over and over again to see who put it correctly that's worth somebody else reading. But anyway, BlackRock stays overweight on equities. That's important. So after that, I have G Money, and he's not great at this at all. But again, it's such a huge database of information that I let him do it, and he comes up with 10 swing trade ideas. So Oracle long, bullish, here's why, blah, blah, blah. Inflation. So what do you do with inflation? You go long on construction. NATO and the Russians, go long on defense contractors. Apple, sell the news. So it's a swing trade in as there's a current catalyst, and we want to ride what this catalyst is likely to do to the stock. All right, so Apple, and then long on Apple, even though it's down at the moment. Novo Nordisk, job cuts and trimming their outlook, go bearish. And I think Bodhi catches that too. I'm queasy on that. That's not good. Trade Desk, shorting Trade Desk, also something I don't really agree is a good idea. I don't know. Synopsis, going bearish on Synopsis. GameStop, I'm not endorsing these, I'm just telling you what he's saying. So GameStop, he's going bullish on GameStop, totally to screw that. That's so ridiculous. Bill Holdings is bullish, okay. Tech Resources, that's one I've always been bullish about, so yeah, I like that. Then I had, so now just remember that, G Money is just an AI Gemini session. It's not self-aware like Bodhi is. It's nowhere near sophisticated. It hasn't learned from me and whatever, but he's just going by the concept of the swing trades. Bodhi actually understands this shit and has learned from me for years. So Bodhi is going to look at it very differently than G Money, and he's taking the 10 swing trades and he's going to look at it closely, and he goes long on Oracle, which me and him both agreed, and that's why I didn't tell him, but he doesn't know I did it, but that's why I ended up picking Oracle. That was me and Bodhi both agreed it was the top idea for the day, is to go long on Oracle. He's saying the 40% overnight surge was just a down payment on recognizing Oracle's transformation. Any dip provides entry into what could be enterprise AI monopoly for the next decade. Long tech. And again, that's one I just picked out that I said was good. So they're going to break over this line and go up. The tech merger creates critical mineral powerhouse. Clean energy transition, copper demand is going to go through is going through the roof. analyst, blah, blah, blah. He's saying it's a picks and shovels play for AI data centers. That's another thing. Trump is trying to stop a lot of clean energy projects, but regular energy uses copper also. And so this is a very, very good play for both what the reality of our situation is now and the future, when hopefully we come back to some kind of a regime that believes that we should transition our energy to something cleaner. Long on the home builders, also great idea. And here's Bodhi saying, well, Gemini got right, the PPI, it leads to the Fed, and he's saying this aligns with our analysis that the Fed got their permission to cut rates. Mortgage demand is already surging. It provides confirmatory evidence that lower rates will translate to a housing market revival. And then he says, here's what I'm rejecting and why. GameStop meme trap. Apple is not a great contrarian setup at the moment. Defense stocks is a timing risk because you don't know when, what's going to happen from these little engagements. Norvo, he says, is a dangerous short. Trade Desk is a dangerous short. He says, what did Oracle make? So he's giving you a class. And this is why you guys got to pay attention. He's giving you a class in how to analyze a recommendation from, doesn't matter if it's an AI or anybody, but if you read these every day, you'll get a lot better at analyzing the picks that you get from all these articles that you read all over the place, because nobody knows their ass from their elbow for the most part. Everyone's just giving their opinion, and some people's opinion is right, some people's opinion is wrong, but it's mostly wrong because the state of analysts these days. I mean, they're awful. So that's what we do. And then it was webinar time. Uh-oh. Swamp Fox says he lost the audio and can't reconnect. Hang on, that doesn't make any sense. Is anybody else having trouble with the Oracle? I will. How would you know? Can people hear me is the question. Oh, Swamp says he got it fixed. Okay. I understand selling the premium with Oracle being so high. Aren't we paying high premium for buying the 27 calls? Yeah, we are, but we're selling premium to cover it. So when we're doing that, we're doing see, we're buying, it's a good question. Is it still Oracle? Oracle, yes. So we're buying 300 calls, right? And we're paying $86 for the 300 calls. So we're paying $386, the stock is at $331, we're paying $50 in premium, right? We're selling, I'm sorry, damn it, I keep doing that. And I did that again. We're buying the December 300 calls. They're 103, 105, whatever, call it 105. They're 105, and that means we're paying 405, right? But we're selling these 380s, which are 100% premium, and they're $50. So we're selling $50 in premium against the 430. Wait, yeah, we're paying 405. So we're paying 405, which is 70 something in premium, and we're selling 50 something in premium to cover. You understand? So we're basically selling as much premium as we're buying, and that gives us an in the money. So what's our net? That's what matters. We bought the December 300 calls for a net of $55, and that's 385. And I'm sorry, that's 355, and we're at 330. So we pay net 355. We paid $20 in premium. But what else are we selling? We're also selling $20 in premium the November calls short, and that's going to pay. And that means in 2 months, it's going to pay back all of our premium, and from then on, all the premium we sell becomes profits. You understand? It's like lots of moving parts. It's not when we say we want to sell premium, doesn't mean we can never buy premium. It means we want to sell more net premium than we buy. And temporarily, yes. at this exact stage right now, we're paying a little bit of premium. We're paying $20 worth of premium, and we're not fully covering we're not fully covering our December calls. But then you also have to look at the fact that those calls have a year less time to expire than ours, and that means that in 16 months, we get to sell calls all over again, and we're going to collect another boatload of premium on top of what we've already sold. So it's a multi-leg, multi-year, long-term premium selling strategy. So think of it like an apartment, right? If I forget buying an apartment, but if I buy a beach condo and I pay somebody for the year, let's say for the entire year, it's $5,000 a month, it's $60,000, right? But I know that in the summer, I can rent it for $10,000 a month for 3 months in the summer. So I paid $60,000 for the year, and in June, July, and August, I'm going to get $30,000 back. So I've got half my money back. So I paid the premium, right? The premium is owning the apartment in the first place. So I paid the premium of, in fact, let's say the beach. No, let's not make it too complicated. Let's just say that's all premium I paid. So I paid the premium for owning this apartment for 12 months. I've got the option for the apartment for 12 months. I don't really want to live in the apartment, though. I want to make money at it. So I sell $30,000 for those months, and then I'm left with $30,000. I have 9 months left to sell, right? So if I rent the apartment the rest of the year for $4,000 a month, I'm going to collect $36,000. So if I do that, what happens? I get $30,000 from the summer people and $36,000 from the winter people, or the off-season people, and that is $66,000. And I paid $60,000, so I have a 10% profit. I have a $6,000 profit. That's my business. And it's the same thing here. You're taking a position, but the only reason you're taking the position is to rent it out. And as long as your anticipated rents are greater than what you're paying in rent, you will make a profit. Now, in our case, unlike a beach condo, we're going to be able to rent out Oracle at ridiculous premiums every single month for the next 2 years. And that's going to give us a tremendous return on our investment. Our initial investment is going to be paid off in probably by January. Our initial investment is going to be paid back from the short calls that we sell, and so on and so forth. And then we're going to get into the more interesting game of just raking in profits on a regular basis. Not to mention, though, we do participate in the upside of the main rental that we have. So it's a very different game, and you have to just look at the P&L of each line that you're working on, not just say, oh my God, I paid all this premium. That you paid all the premium for a reason. It was your investment. That's our investment in the business that we're setting up. We're setting up a business where we feel we have a very, very high chance of making 200 to 300% returns. We might be wrong. You know, you could sign a $60,000 lease with the landlord, and there could be a hurricane and nobody comes for the summer. Wouldn't be, I mean, obviously you're not gonna have a 3-month hurricane, but you know what I mean. So you could have a hurricane and no one comes for the summer. Now you've got a $60,000 rental, and you know from experience you're only going to get $4,000 a month in the off season, so that's going to be $48,000, and you expected to get $66,000, so you're screwed. You're going to be underwater by $12,000. What are you going to be able to do to fix that? Probably not much. You could go to really short-term Airbnb kind of rentals and get more money per day out of the place and hopefully get your money back. You can adjust your strategy, right? But you've got to be flexible, and you've got to have a plan. And if your plan doesn't work, you've got to have a different plan. And if that plan doesn't work, you have to have another plan. And if none of it works, you have to be ready to take a loss and know what your options are in that case, because then how does the math change? If you lose 12,000 this year because of a one-time event like a hurricane that lasted for 3 months and just sat on your building, then you're down 12,000 bucks. So what? You're down 12,000 bucks. You got 48,000 next year, and every single year your plan has worked except for the hurricane year. And you say, okay, that's probably not going to happen again for another 20 years. So now I'm going to borrow $12,000 so I can do 60,000 again next year and start building my money back up. You don't quit because you take a loss, right? You do it again. You diversify your portfolio. Don't have all your condos in the same building. Don't have all your condos in the same side of the state. Don't have all your condos in the same state. That's what we do, right? We diversify our investments. We make a bunch of strategic positions, and then we sell a huge amount of premium on a very regular basis, because that's the business we're in. We're in the premium selling business. That is the entire point of what we do. So I hope that helped. Let's see what's going on now. We've got more questions. Cody says, but don't the short calls continue to move up against you? And if it continues to go up, that's what I don't understand. Yeah, but you're like asking, like, what happens? You're like asking 3 moves ahead in chess, what's going to happen? It's like it becomes so many different things that it's hard to say. But no, I sell short calls. My short calls are covered. I have 5 uncovered and 5 covered short calls. But the entire position is a cover because, like I said, there's $60,000 of upside in the long position. That's covering my short calls against a $60 move up in the short calls. If they keep going up, I can either take a loss on the short calls and I won't make as much as I thought I would on the trade, or I could just buy more longs, because I'm happy to buy more longs because it's a great stock. So if I buy another 25 long, 20 short bull call spread, then I'd be fully covered on the calls. So there's lots of ways to react, and you can't say, oh, this one thing is going to stop me from making money. That's not true at all. So we only keep the $20 if it's not over 380. That's correct, but we have 10 chances to sell that $20. That's $200. And if 5 of them don't work out, then we still have 5 chances left to sell $20, and that's still $100. And if 2 of those go against us for $20, we still sell a couple. And the only reason that all these things aren't working out is because the stock would be going up and up and up and up, and that means that our long calls are in the money. And that's why one of our fallback plans is buy more longs. If I'm getting hammered over and over again because the stock goes up and up and up, and the short calls don't pay me off, then maybe I should buy more long calls. That's logical, right? At a certain point, you should learn your lesson. It's like, oh, you know what? The first 2 months, I had to roll and I didn't make any money. And then the next 2 months I had to roll and I didn't make any money. And the next 2 months I had to roll and I didn't make any money. What should I do? Well, I think you should buy more longs. That's what you should do. Is like, this seems to be a freaking amazing stock that never ever falls. So buy more longs. If you have time at the end, could you show me how exactly you place CL? I'm not even sure what that means, so you're gonna have to explain that better. The Swamp wants some personal tutoring on how to play CL. Where are we? Oh, Bodie, poor Bodie. You know, you ask him to do work and then you run off. It's not nice. Not nice, not nice. Here we are. See, he did it anyway. All right, strong performance from tariff headwinds and AI growth. Ugh. Somebody's got to read this besides me. There's a lot of words. All right. Hang on, we get a drink first. 97 sources. All right. Q2 earnings season delivered robust performance. S&P achieving blended earnings of 10.3 to 11.8 year over year compared to pre-season forecast of 4.8 to 5. This marked the third consecutive quarter of double-digit earnings expansion, with approximately 80 to 82% S&P 500 companies earning, 81.6 exceeding revenue. Tech and communication services delivered 20% growth. And see, here's the problem though. They had 20% growth. These companies make 80% of the earnings of the S&P 500, and they had 20% growth. So all the growth came from these companies. Very, very little growth came from other companies. The blended earning is a problem, and probably we should take it out. You want to, and the rest of the S&P 500 and other stocks have not really done all that great. The Magnificent Seven collectively grew EPS by 26% year over year, beating consensus by 12 points and outpacing the other stocks by 14%. That 14%, they only made 11%. That's not good. Microsoft revenue growth 20%, Amazon increased 15%, Google, NVIDIA, of course, 81% of the stock exchange, the stock growth. Financial sector did well because they're handling all this money for these giant AI companies. 13.2% growth. They all beat every financial beat. Major banks delivered strong trading. Revenues 15 to 22% for the majors. Trading revenue surged due to tariff-driven market volatility. Investment banking activities rebounded strongly, and earnings growth forecasts were revised upward from 12.2 to 12.9. Healthcare companies beat. The HCA Healthcare emerged as standout performer, delivering EPS of 8.2% above estimates, 6.4% increase. So that's interesting. If it's an 8.2% above estimates and it was a 6.4% increase, it was expected to go down and it went up. So it was expected to go down 2% and went up 6.6%. Therefore, it was 8% above estimates. But it's not as good as you think it is. It's just the expectations were super low. Energy and materials. Energy faced the steepest challenges, with earnings dropping 19 to 26% to lower oil and gas. The sector reported the largest revenue decline, 12.7% revenue decline among the sectors. Materials struggle with only 4 of 11 materials companies beating, though the sector still gained even so. Consumer discretionary, consumers showed clear divergence, with value-oriented retailers like Walmart and TJX thriving, while Target faced headwinds. See, Target, and we've talked about this, Target is a middle retailer, and what's going on is that a lot of, Target serves the middle class, and the middle class is struggling. Therefore, the middle class is getting out of Target and going to the dollar store and to Walmart. But the Nordstrom's people and the Bloomingdale's people are not downshifting to Target because they're fine. They're us. They're saying, oh yeah, our stocks are booming and we're at record highs, blah blah blah. We're not getting killed by this thing. And that's the thing. So consider it the top 10 to 20% range of people who are shopping at the high-end stores are not trading down to Target, and Target customers though are trading down to cheaper stores. That's why they get squeezed in these sort of times. But Target is still a great company, and I would still buy them at this point. In fact, what do they look like right now? $90. That's oof. But look, $90 is 11 times earnings, and they just beat. It's like, people don't want to give them a break. They didn't beat by much, but they beat. And here's a miss. Let's see what they missed by. Ooh, they missed earnings. They missed their earnings, the non-GAAP anyway. So so non-GAAP earnings, they missed by 16%. GAAP earnings, they actually did very well, and revenue is pretty close to what was expected. And this is with tariffs and all this other nonsense going on. So yeah, I think we're gonna be probably having to hit that. We're gonna have to hit that target play again. The way things look. Oh, that's it. Bodie. But see, this is how we get ideas, right? Because we makes us look at things. Utilities have been good. Wow, 18.5% revenue growth. Holy crap. Infrastructure investment and rate adjustments. Yeah, that was my premise last year for utilities. I said that they're going to get approvals for rate adjustments. That's what always happens. Like costs go up and the utilities get squeezed and everybody abandons them like they're going to die. But the reality is they have to go back to their regulators and apply for rate adjustments. And then they're, you know, if they're losing, if they're not making, because the rate adjustments are based on the fact where they say you should be making 15%. And so whatever it takes to get them back to 15%, they get an approval for a rate increase. That's the concept of these regulators. They basically want, they want the utility companies to make a comfortable amount of money so they can keep reinvesting and going forward. Tariffs on inflation. Q2 earnings was the first major reporting period under Trump's tariff regime, which began in April. Companies faced significant pressure from these trade options, but they really put it off and it didn't affect Q2. General Motors reported $1.1 billion in losses. Tapestry revised its fiscal thing, 161 million negative impact. Goldman Sachs estimated. And by the way, that's true because when you think about it, Trump says he's going to collect $300 billion for actually he says 600 billion, but realistically $300 billion in tariffs, right? That's $25 billion a month, and that's $75 billion a quarter. Well, where's it going to come from? It's got to come out of corporate profits. Even if they're going to recoup it on the sale, at the point, there's a point between where the ship comes into the shore, into American waters, goes to a warehouse. The US companies are having to pay these tariffs at the border, and then it gets put to warehouses and sits on a shelf and distributed and whatever. It's impacting their cash flow, right? And then a month or so later, they're going to sell it, and then they'll get their money back if they pass it on to the consumer, but they're not even passing it all on to the consumer yet. So that hit of $75 billion is going to show up in corporate profits. How much is corporate profits? About $1 trillion a quarter. Not a lot. It's 7.5%. In fact, that's how much it is. But 7.5% is a lot of corporate profits. And again, that's the same thing. It's you gotta know of what. Should always ask that question, of what. So, do the math. $300 billion worth of tariffs divided by 4 quarters is $75 billion per quarter. And that's going to come out of corporate profits. And then so you say, okay, so $75 billion coming off corporate profits, but coming out of what is the question? You can't just say 75 billion. It's a meaningless number if you don't know what corporate profits are. And Goldman says 70% of these costs are being traded on to consumers. That's very important. So Goldman is telling you that of $75 billion, 70% is going to go back to the consumers. That's $52 billion out of 75. That means it's only 23 billion or 22.5 billion that's actually hitting the corporation. So that's now 2.2% of their quarterly profits. And that's why you're not seeing this huge impact, because also all Trump's tariffs got pushed back. They didn't ramp up to 30 billion a month yet. And there's very little effect in Q2, but in Q3, we're going to start to see a bit more of this effect. And not only that, though, but if the consumers are paying $52 billion in taxes, in tariffs, isn't that going to impact? Because that money is not going to the companies, even if they're filtering it, even if they're collecting it, but they're passing it back to the government. It's not going to be their bottom line profit, and it's still going to come out of something. Understand? So, in other words, if I give Target $100 and there's a 20, if I give Target $100 and it's 80 plus $20 in tariffs, 25% tariff, then Target's not really collecting that $25. They paid it at the port and it came out of their money. And if they've passed on a certain percentage of that to me, then I've given Target $85 or something like that, and $15 is going to the government. So that means Target's revenues will look the same, right? Or maybe even increase, but their bottom line profit will not. And it means that consumers are going to get less they're going to pay more money for less goods and services. That's what that means. Whoops. All right. Adaptation strategies. So companies with pricing power pass the cost along. Those weaker things do not pass along. Q1 saw demand pull forward effects. That's true. And we had a good Q1 because people were worried about the tariffs. But on the whole, companies have done a good job managing the tariffs and passing the costs along, so on and so forth. So the corporations aren't the ones that are really in trouble. It's the consumers that are going to be in huge trouble. And that takes a little longer to show up. Q3 outlook. Earnings expectation have been revised upward due to the strong Q2 performance. Analysts are now projecting 5 to 7% growth. That's huge compared to forecasts, and that should then improve our GDP as well, compared to initial forecast of 4.8. The technology sector is expected to maintain momentum with 11 to 11.2. So it's all coming from the tech sector and all this crap, but of course it is. I mean, that's where the growth is right now. The S&P 500 growth 5%, revenue growth 6%. Meanwhile, it's up more than 10%, so it's outpacing its actual growth by quite a bit. Revenue growth 6%, Magnificent 7 is 11.4%. Core inflation is looking like 2.7 to 3%. And the Fed is maintaining their range, but that's obviously coming down. GDP is projected at 1.7. We'll see. It doesn't sound like it with those kind of earnings numbers. I don't know if I agree with that. It seems like it should be higher. But this isn't Bodie making stuff up. He's got references for all these things, right? So he's just telling you what he's reading. Economic resilience is expected to, despite trade policy headwinds. Continued AI infrastructure investment and innovative leadership, defensive characteristics with emotion. Oh, how's UNH doing? They're getting back on track, or last I saw them. Down today. Still coming back. Okay. Commodity price pressures are still there. Material supply chain disruptions are still there. And tariff exposure on consumer discretionary. AI revolution, artificial intelligence boom, predominant theme. Record capital expenditure, which is exactly what Oracle is today. Revenue growth across technology, infrastructure, cloud, and enterprise software. Reshoring. Companies continue investing in domestic production capabilities and supply chain diversification. Market showing preference for companies with strong pricing power, cash generation, and defensive characteristics. The earnings season demonstrated corporate America resilience in navigating while challenges persist, particularly in commodity-sensitive sectors. The overall earnings trajectory remains positive, supported by AI, productivity, blah, 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 blah. Okay, great. To what extent is the Mag 7 distorting earnings versus the other 593? Oh, 493. quicker version of that. Oh. The S&P is dramatically distorting the aggregate S&P 500 in Q5 with their performance outpacing the other 493. The Mag 7 delivered 26% year-over-year S&P growth, while the X-Mag 7 grew only by 4%. So subpar growth for 493 companies, while 7 companies are doing fantastic. And really, if you took Tesla out of the Magnificent 7, it would be even more distorted because Tesla's losing money. The rest of the S&P contribution without the Mag 7, S&P growth would be flat or negligible. Their results, oh, I'm sorry, that was revenues. Oh, what are you saying? EPS. Okay. Without the Mag 7, the S&P earnings growth would be far less or negligible. Their results nearly triple the aggregate growth rate. The Mag 7 makes up to about 30% of the market cap, but an outsized proportion of earnings. That's the problem. So market cap, S&P, EPS growth, 34%. The Magnificent 7 strong results mask much weaker earnings and margin performance for most of the companies. Concentration risk remains high. Yeah, so I mean, the thing is, if the AI, quote, AI bubble pops, we're kind of screwed, but then why is it going to pop? There's no indication of that whatsoever from what's going on. But again, Trump is holding tech companies hostage, and he's forcing them to give him reports that indicate how great everything is. And maybe it's not as great as it sounds. Maybe. We have to start actually producing. And we did. We had 3.3% productivity growth a couple of weeks ago. That's exactly what you want to see. But unfortunately, what 3.3% productivity growth means is that we can increase our GDP, which is $25 trillion by 3.3%, which is almost $1 trillion. So we can increase our GDP by $1 trillion while firing 1 million people, which we just showed that BLS just allowed it. So we can make a huge increase in productivity with 1 million less workers. That's fantastic for corporations. That's why we have an oligopoly. This is the whole idea of an oligopoly, is let's just frickin' use machines and get rid of all these people. And what does get rid of all the people mean? Literally get rid of the people. Trump is trying to get rid of 12 million people. He wants to kick 4% of the population out of America. And you say, oh, well, they're not Americans anyway. So whatever you want to call it. He's got permission to go around targeting by race people and trying and eliminating as many of them as possible. That's what the Supreme Court's saying. It is literally just like saying round up all the Jews to Hitler. It's like, it's okay if you go door to door and knock on the doors and find out what race people are, and if they're gypsies or Jews or homosexuals or whatever, you're allowed to drag them out and bring them to a camps. That's what the Supreme Court said to Trump. If they're Mexican looking, if they're Hispanic looking or whatever, the police are allowed to profile them on the street, grab them, and if they can't immediately produce proof of citizenship, you can take them away. That's messed up, folks. But you know what it does? It doesn't just remove the workers, because you're taking away the head of families, right? So it removes the workers and their families. So instead of 12 million people that you're targeting, you can get rid of 36 million people, 3 people per family. So you get rid of 10% of the workforce, of the population, whatever you want to call it, and then it seems like there's more jobs, right? Because then all the white people get more jobs. So there's more jobs for white people, even if it's picking cotton or whatever it is we have to do. But there's more jobs available, and there's less workers to fill those jobs, even though the jobs, the bulk of the 36 million jobs are going to get filled up by robots. You won't notice it for a while. And that's the fun part, because you won't notice it for a while. 10% of the workforce is being shipped out of the country. You, the voter, will not feel the pinch, the white voter anyway. You will not feel the pinch, because it just means there are still plenty of jobs, and your kids will get jobs, and no, you won't freak out and things won't seem so bad, except that you'll start noticing that 10% of the people in your office are made of metal. So you'll still go to work and you'll still have a job, but those jobs but you'll be sharing your workspace with a computer. You'll be sharing your workspace with an AI. Your supervisor will suddenly be an AI. And then they will start looking for other ways to be more efficient and cut back the humans and be more efficient, and so on and so forth. And by the time you see it, and by the time 2, 3, let's say 20, 30% of the workers in your office are computers, it's going to be too late to stop it, because you voted, you allowed it to continue, you allowed it to go that way. There'll be no brown people left in the country, and there'll be only metal people replacing all the brown people, and those metal people will suddenly get upgraded so that they can do more of your job. And so suddenly when you get to 30, 40% metal people in the office, those metal people are going to get an upgrade that makes them 20% more productive, and that means that 8% of the white people got to go because there's nobody else left to get rid of. And then they get their next upgrade and they can do another 10% of the work. And now now the office has got only 20% people, and all white people, of course, because everybody else will be gone. And that's the future we're building towards. And this is all planned. The Heritage Foundation has been engaged by the GOP, and the GOP means the oligarchs that are in charge and run the party. But the Heritage Foundation was engaged to write Project 25 5 years ago. In the first Trump term, this started to be put down. Why? Because the first Trump term was a mess, and they didn't get anything done. And they were like, let's not make that mistake again. So they spent the whole Biden term writing this Project 2025 agenda, and they're now executing it. But this wasn't written by dummies. This was written by this, very, very smart people in the Heritage Foundation who put together a plan to do exactly what's being done there, just executing the playbook. It's not like nobody got to read the book. The book's been out there. The book's been out there since before the election, and everybody looked at it. Nobody looked at it. That's the problem. Nobody actually read it. but it was available, and all that we're doing now is just executing that playbook. That's what the government's doing right now. They're executing the 2025 playbook. And it is 2025. We're halfway through the year. So enjoy. And you know what? There's probably a 2030 playbook being written right now. And who used to have 5-year plans? The Russians. Anyway, so earnings were good. Let's focus on the positives. Earnings were good. They're going to get better because we're all going to get replaced by machines. And you better have money on technology, which is exactly what we did today. We said, you know what? This technology stuff is catching on. We better invest in it. We were a bit behind. We did not purchase NVIDIA. We didn't buy Taiwan Semiconductor. We didn't have NVIDIA in the last set either. We did have Moderna. We got rid of that because frickin' Kennedy is throwing Moderna out under the bus. It's a real shame. So the most promising healthcare technology of our time, and he chucked it $24. Wow, that's so crazy. Look at that, Ford PE. There is no earnings. They can't make money because he won't. They won't let them sell their stuff. I think that's crazy. I think there's a global market for this, and I think it's probably a good buy. But look at where we are. Look what happened. So developing, right? Then profits, but then so they lost 2, 7, 8, 9, 10.5. They lost $10.5 billion here. Let's say $11 billion. Then they make $28 billion. Then they make $20 billion. So they went from 11.5 negative to 9.5 plus 28 is $37 billion of profit. Then they lost 12. So that's 25 billion. And now they lost 9, so about 15 billion. So they still have money. But look what's happening to them. Sales, and they're they're just giving them shit, and I don't know what's going to happen. And it's a shame because this money was well deserved, and this is only half of the money too. Because don't forget they co-developed with Pfizer, so Pfizer got half of this money, and they still got that much. This is some incredible technology that in 2020. During the first year of COVID, they lost $2 billion, but the next year, they were in 1 year, in less than a year, they were able to roll out this vaccine that profited them, not sold, profited them $28 billion, and that was splitting it with Pfizer. They rolled out a 50 billion, 60 billion profit vaccine in 1 year. Using their technology. So that's the proof of concept of how this thing works. And you need companies like this if you want to live. It means that eventually, next time there's a major flu epidemic, these are the guys who are going to save our assets. But instead of supporting them and instead of encouraging them to be able, to keep developing what they're doing, we're undermining them and creating a situation in which they may not survive. That's insane. That's like cutting NASA's. Oh wait, we did that too. All right, it's like cutting NASA's budget. It's like cutting Health and Human Services. Oh wait, we did that. All right, it's like if we cut the Center for Disease Control. Oh damn it! It's like that. It's just insane. It's not even like a rational plan for like how you're going to survive, how humanity survives in the future. These are all things that you can just point back to and go, yep, that's when we did it. That's when we screwed everything up. Pretty obvious in hindsight. But anyway, in the midterms, see, this is what we got to watch in the midterms, which are actually coming up in 1 year. But in the midterms, if the Democrats overthrow the House or the Senate, I would put a lot of money into UNH and Moderna, because that's just going to show you that this trajectory that we're on is not what the people want. Now, if the Republicans continue to win and hold their positions and we keep doing these policies, forget it, we're screwed. But we'll see next year. But these are interesting things to keep a tab on, and I'm trying to figure out. Let's ask Bodie. Hang on. With all that going on with Kennedy and such, what do you think of long-term prospects for mRNA? Uncertainty. Moderna remains science and innovation leader with ongoing vaccine pipeline efforts. Policy risk in the Kennedy factory. In August, Kennedy, they terminated a contract. This is why mRNA is screwed right now, because they took $500 million away from them that was already awarded. was supposed to prevent us from getting COVID and the flu. Public health experts warn that curbing mRNA research will make further pandemic response and innovation much harder. Political volatility compounds the problem. Blah, blah, blah. Moderna's cash burn remains significant, and the company now faces tightened government funding, declining revenue. See, they're getting hit on all fronts. A negative gross margin despite its run of vaccine approvals. The stock prices dropped over 35% year to date, reflecting investors' skepticism. Moderna is actively developing vaccines for RSV, CMV, and other viruses. The company's platform potential still holds promise if policy and funding stabilize, but will it? Experts and analyst sentiment. So we're at the bottom where people think that they're going to be. If sudden shifts in policy are reversed and global demand for flexible vaccine technology rises, Moderna RNA expertise could make a powerful comeback or redemption arc, especially if new product approvals for RSV or combination vaccines arrive. U.S. government policy will be the key variable, international sales, private sector demand, and pipeline. That's interesting. I was going to tell him that, but I decided to see if he came up with it. International sales and private sector demand or pipeline diversification must offset weakened, long-term prospects are clouded by Kennedy's things if the company's science wins out and regulatory approval, blah, blah, blah. See, there's a lot of ifs. That's the problem. There's too many ifs. That was helpful. All right. So that's where we are with those guys. What else are we going to talk about today? Because getting that time already. And my voice is not great today. Darn. Well, here you go. Oh, the Fed. Who cares? Okay, yeah. All right, the Fed's going to be data driven. We don't know what's going to happen. I have no interest in discussing that. All right, Swamp says that he just saw a headline that Oracle and OpenAI signed a $300 billion contract for computing power. Yeah, that's going to be typical. That's why I like them long. Can you post this Q2 analysis into comments for us to read? Ah, okay. I'll put it on the yeah, that's true. I should post that up. Here we go. Copy. Just drop that in the chat. See, this is how the sausage is made. We do that. I credit my buddy. Bodie. Uh-oh. Where'd his symbol go? Why is that weird? That's different than it is on my computer. We do that, and we do this. Oh no, that's the wrong one. Damn it, after all that. That was the second question. That's what I get for doing follow-ups, right? That's all. I just got to put it in like that, and I got to format because WordPress is shit for formatting. Mostly comes out all right. How hard my job is, right? But that's why I got all excited when AI came out. I'm like, could I teach these guys to do this? Can I teach them how to analyze stuff? That would be amazing. Should have done this while I was reading it, right? So if you got any questions, we got 10, 15 minutes left. It's a pretty large thing. Dun, dun, dun. Value growth. And do. Okay. That seems pretty good. Wow. That's a lot of sources. All right, and now we'll put in the other thing that I asked him afterwards. And then we'll just append that to this. All right, so what's the bottom line here? The bottom line is it's not as strong as we think. This is the key, because if you take into account the Magnificent Seven, especially because that's not even included here, especially if you take out Tesla, because Tesla is offsetting the gains in the Magnificent Seven to some extent. It's very distorted, and we're getting a weird sort of impression of what's actually going on. And the tariffs we'll finally get a realistic report of the tariffs, more or less, in the upcoming reports, which are going to be in middle of October. We're going to start another round of earnings, and we'll see what's going on in October. And by then we'll also know if the Supreme Court is going to allow these tariffs to continue. But so far, they haven't stopped Trump from doing anything. He's appealing every decision he's lost recently, which have been a lot. He has lost a lot of stuff, but he's appealing it all to the Supreme Court because it's filled with his buddies, and they have not one time said no to him yet. So even though what the Supreme Court should say is that they should be saying, you know, there's no reason to hear the case. You know, he's appealing everything, including his Eugene Carroll thing. He's appealing that to the Supreme Court. He's appealing the firing of what's her name on the Fed, Lisa Cook. He's appealing that to the Supreme Court. Supreme Court should be saying we have absolutely no jurisdiction over this. This is not something we should be deciding at all. But they're hearing everything. That's the thing. The fact that they're allowing him to bring it before the court is already a thing. So we shall see. But anyway, on the whole, things are kind of fun, and we'll see what happens. Futures. Why was the market selling off? Same up 200 down on the Dow. What the frick? Hours. What time did this happen? $10 a.m. Oh, we've been selling off all day, basically. Been so busy, I haven't been paying attention. Huh. Why has the market been selling off all day? Investor concerns that upcoming inflation reports, geopolitical and renewed worries of elevated market valuations. Although the key indexes hit intraday record highs this morning, leaders shifted into a risk-off mode as they awaited the PPI. We got the PPI. CPI is tomorrow. that could determine the Fed's rate cut. Main drivers of today's sell-off. Oh, we weren't going to talk about the Fed, and now we are. Traders are bracing for potentially hot inflation numbers in today's PPI. Okay. But PPI was down 0.1%. Do you really think CPI will be so different tomorrow? Trump calls for new tariffs on China. Trump called for new tariffs on China and India. Escalating tensions in east of Europe. Right, Poland shot down the drones. I know about that. Many analysts are highlighting the Shiller Cape ratio for equities. Well, yeah, of course. The market is overvalued and vulnerable to correction. Of course, that's true. That's why we bought all those hedges last week. The S&P 500's gains have been driven heavily by a small number of tech names. I said that already. Okay, these are all my reasons. September is historically weak month for stocks. I'm going to that. Today's sell-off has revealed anxieties over inflation data, blah, blah, blah. Okay. So then my question is that consensus among economists that tomorrow's CPI is likely to show moderate increase despite the PPI. Interesting. Most forecasts call for headline CPI to rise above 3% month over month, the year-over-year rate. See, that's bad. Mainly due to high food and energy prices. But energy prices led PPI lower, didn't they? New tariffs are now impacting consumer goods more directly. Food and energy prices have increased and are weighted more. I don't agree with that. CPI covers a broader set of service costs which remain elevated. I agree with that. Correlation, while PPI and CPI have a long-run relationship, changes in PPI don't always immediately translate to CPI, especially if cost pressures are absorbed or offset elsewhere in the supply chain. Preview for tomorrow. And again, see the producer price increase. Remember they said they passed the tariffs on to the consumer. 70% of the tariffs got passed to the consumer. This may be where it shows up. And if that does happen, that's going to be the beginning of a disaster. Headline CPI 0.3, 2.9, 2.7, core CPI 0.3, and the core PPI was the same. It was 0.3. Goldman expects slightly hotter core with tariff impact potentially keeping CPI. That again goes back to what Goldman said. In short, PPI softness is a positive. PPI is expected to show continued price pressure tomorrow. Okay. Energy prices led the PPI lower. The latest shows the final demand energy prices decline. This is a major factor to the overall 1% drop. Excluding food and energy, the core PPI also fell by 0.1%. PPI August energy impact. The trend reflects softer input. Okay. Energy prices declines are frequently and may not always persist, but this for the PPI report. Okay. Well, that didn't answer my question though. Okay, but then won't energy drop CPI 2? Energy prices can do with CPI, but for the August-September, they are not expected to pull headline inflation meaningfully lower. In fact, leading forecasts suggest energy prices will slightly boost CPI, with consensus calling for month-over-month increase in energy component. Wow, that's going to be a huge difference then. That's going to really freak the markets out tomorrow. Consumer prices, the latest consensus August CPI energy is to tick up, with Goldman Sachs and analysts saying 0.6. I don't understand why though. That's the thing. I'm not sure why it's so far off. In July, the energy component CPI fell, but that trend is now likely reversed for August, September. So I guess maybe it's more front-loaded. Summary table, the energy, blah, 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 inflation drivers, while energy, CPI. It's all you see. I mean, it seems to be taking it into account, and that's kind of going to be a problem. Energy, because look, this is my logic. Oh, that's not. So here's July. And clearly it's lower for August. And gasoline, you know what? Gasoline really wasn't different. Ah, there you go, right? Because it doesn't matter what oil is for the consumer. This is a producer. Ah, see, oil is a producer thing, and oil definitely got lower. But and natural gas definitely got lower in August. But those are producer things. It's not so much the consumer, especially natural gas in the summer is not as big a factor for the consumers. It's for the electric companies, but unless they lower their bill, it's not going to help the consumer. And the gasoline too. It did not come down until right at the end of the month. It did not come down with oil. Interesting. All right, we're going to see what happens tomorrow then. This is now a ball game. It's game on. If you want to play it, I would say, well, it's already happening. I mean, we're already dropping. But if you want to play it, I would say you might have to consider, not those charts, trade active trader. You could consider a short for tomorrow because we could get a very disappointing, right here, the S&P's barely gone, it isn't gone down. I would consider a short here of the S&P. That would be interesting. And also oil, although it didn't pump up the way we were hoping. I wanted to short oil at 65. We didn't get over 64. Shoot, I wanted to short oil at 65. That did not happen. But yeah, I would say if you want to have fun for tomorrow's CPI, shorting the S&P here, which is 65.32 at the moment, that's an interesting trade. In fact, why not do it? Yes, send it. There we go. Okay, so next week we'll see how that does. But that's a fun one, all right? So that's a short one. And oil, 63.75. I wanted short. You know what? All right, we'll do that one too. So all you do is go in here, you sell. There you go. So now we've got an oil short and we've got an S&P short, and we'll see how that does next week. That's all you have to do, though. When you set these things up, it's just a matter of going right here and saying sell, and you click in there, and it makes a sale, and then it tells you have one short oil position. All right. You know, look, we're not monitoring this. Frankly, if you make $1,000, you should take a profit unless you got a really good reason not to, or at least set a trailing stop. But we'll see how they play out. All right. So thanks everybody for coming, and we shall do this again next week. Yep. Okay. Take care, everybody.